All righty. Well, thanks for joining us. This is a Seattle Angel Conference workshop on milestones for fundraising. My name is Yoko Okano. I am currently one of the founding partners of First Row Partners, but previously I was with Seattle Angel Conference as the fund manager for round 14. And my partner, Minda Brusse, who will probably be back on screen shortly, was the fund manager. Oh, there she is for round 16. And since then, we have started our own pre-seed venture capital firm based here in Seattle. Before we dive into the content today, I know John typically likes to start these with introductions. So a quick round of intros. We'll keep it really short so we can get to the content, but your name, maybe where you're located, and whether you're a founder, prospective investor, kind of your interest in this topic would be great. So we'll start maybe with Annie.
Hi, can you hear me?
Yes.
Hi, so my name is Annie. I am located in Seattle, and I am here because I'm currently in SAC and was told this might be helpful.
Awesome. All right, Joe.
Hey, my name is Joe. I'm in Redmond, and I'm a potential founder.
Awesome. Noel?
Yeah, I'm in Seattle. I'm currently just starting co-founding a company called Joy AI.
Wonderful. Let's see. John. Let's go John He.
Hi, this is John. Yeah, I'm the co-founder of Mimax AI. I'm also from the Seattle area. My company started the last of the October, so pretty much we raised the seeding fund. So I'm going to join this event and then to have a little working with you guys.
Wonderful. All right, let's go with the other John, John Levitt.
Hi, John Levitt. I'm a sometime investor, but primarily an operating manager that works with early stage startup companies to identify their beachhead market and go-to-market strategy to be fundable, ideally. So, thank you.
Hello, sorry for my voice. I'm a founder of a hardware and software company, and we are expanding our AI angle. And I wanted to just get a sense of fundraising in the AI space before, because we naturally are evolving into it. We want to make sure that we're doing the right things from the beginning.
Awesome. And then this my West Side Newcomers, is that looks like just a potentially something, someone's note take or something. If you are there, you're welcome to introduce yourself. Okay. And I think, did we get everyone other than Minda?
I'll introduce myself really quickly. So I'm Minda Brusse. I'm the other founding partner of First Row Partners, and excited to be here today to talk about this topic because it is near and dear to my heart after having mentored so many different companies. And I get a chance to do that not only through First Row, but Techstars and at the University of Washington. And so I enjoy learning from all the founders, and I hope that what is clear about Yoko and I is that we never feel like we have the answers, but we feel like we're pretty good at helping to generate good questions.
Awesome. So I will share my screen and I'll kind of keep an eye on the questions as well as any folks who pop up in the session. But I'm really excited about this particular topic. As Minda said, this workshop has kind of come together from a lot of the mentoring sessions that she's done. Minda has been in the startup world for over 25 years. And I think that every time we meet with a company, whether it's a portfolio company or otherwise, I'm just amazed because it's, they're never asking questions she's never heard or thought about before. She's like, I have this, I saw this in this other iteration, and it's always so helpful. So I'm excited to dive in. All right, so Minda, take it away. I will move the slides as
wonderful. Thank you. So yeah, just really quickly about First Row, for those of you who don't know our venture firm, we're pre-seed specialists. And so it's actually 20 plus companies now that we've invested in through our first fund. And we're really excited about the discipline that we've brought to that process, again, by thinking about what are the relevant questions to be asking at different points in time, and what does stage appropriate activity look like? And I think that that's something that Yoko and I are always conversing about and trying to sharpen. we both spend time at the University of Washington in teaching roles. And if any of you know about teaching students, especially at the graduate level, you really better know what you're talking about. And you have some tough customers. And so it forces you to learn, and it forces you to be able to explain yourself. So that has continued to benefit us and our portfolio companies. Myself, I come from having done startups, as Yoko said, and then gotten involved with both 2048 in New York and Crosscut, Yoko and I both down in LA. And investing across the country has helped us build a lot of really great relationships with other venture funds. So what we're going to do today is really sort of follow a three-parter. And that is, one, we're going to talk about just generally, like, why would you raise any money from outside investors and what is this all about? And then number two is really our thoughts on how milestones connect that narrative and how you can explore building milestones that you can fundraise off of. And then we'll go to questions, which I think is always a really interesting part for you to learn from each other based on what people are hearing and thinking about what we all just heard. So, all right, so we're going to start by talking about why some business models are easier to raise angel and venture capital for than others. And on the left-hand side, there's a list of all these different kinds of businesses that you might choose to start. A retail store, a social app, materials science company that sells to manufacturers. There are all different kinds of businesses. And on the right-hand side are all the different kinds of initial or lift-off capital that might be available. And I've highlighted angel and venture because that's what we're talking about here today. But you can see that there are really quite a few different kinds of initial capital that are available. There are a few that are not. Those are listed here. In the middle are really what I want to focus on, which are what are the considerations for a particular type of business to connect with angel or VC. So for example, exit potential. Some business models have higher multiples on revenue for their exits than others, which changes the attractiveness of the outcome for the investor. Some are very capital intensive to build. That changes the dynamic as well. Is your revenue scalable without additional operating resources being attached to it? There are all these things that really sort of connect or don't in various ways. The first one that we're going to look at is enterprise SaaS. You can see lots of green highlights in the middle and green on the liftoff.
Sorry, Minda, I think I went too far. Actually, I meant to go one back.
Okay. We're going to start not with enterprise SaaS. We're going to start with brands. So let's say you want to be the next soup company and you think you've got a really good soup and you want to get it into natural food stores. Well, one of the great things about a brand or a food is that your customer diversity is immense. There are a lot of different people who might be attracted to your soup. So you've got a really big benefit there. The market size is enormous as a result. Now, in order to get a product on the shelf, there is some viability and risk to just kind of getting even to the first bit of revenue because you have to produce a product, get it into some sort of distribution. Revenue scalability means every time you sell a can of soup, you have to be making another can of soup. So every time you make something, you're selling it. So there is a scalability. If someone were to come along and ask you tomorrow to produce 20 pallets of your soup, you'd have a lot of operational lift in capital and intensification of your operational resources that would have to be going there. So all of these things sort of work for and against you as it relates to the business models behind angel and venture capital. So on the next slide, which we saw earlier, it's really about why enterprise SaaS seems so wildly attractive to angels and VCs. Because our business model is predicated on a lot of the things that are in green in the middle, which is having a huge market size with a easy path to first revenue, where we can start seeing customer feedback as revenue. And conditions to scale are really positive in software, especially with SaaS, because it's cloud-based. It's not on-prem usually. And the exit potential, the multiple on top line revenue for a SaaS company, 10, 15, sometimes 20, sometimes absurd large numbers of multiples. Whereas with a brand or CPG, it tends to hover 3 to 5x of that revenue. So the outcomes are bigger potentially. And of course, there are always exceptions to that rule. I'm making broad generalizations. So what I would encourage you to think about is what kind of business are you, and what are the considerations that are red, yellow, and green for your business model as it applies to angel and venture capital? Because alignment is going to continue to be an issue. The kind of business model we have as venture capital requires that when you take our capital, you think of it as kinetic. In other words, you need to load the spring and then take the capital to vault to a new level of value of your company. And then that's going to happen over and over and over again with a sequence of investors. And what we're not looking to do is fund continued operations and linear growth. And so because that kind of capital is applied, the kinds of things we're looking for are specific. And the first thing that comes into play with VCs is really just sort of, are you spring loaded? And so I want you to kind of keep that in mind. Those are signals that are about the revenue you're already showing and the leading indicators that you are growing and going to be generating more revenue. Because again, that's really sort of what we focus on a lot of times because of our model. When we sit down with you, and often there's a power imbalance between the founder and the funder in the room. So what I like to remind investors, myself, and founders is that we are blind. We are the ones in the blindfold. And so essentially imagine that you're walking an investor into an art gallery with a blindfold on, and your company is an abstract piece of art that you're trying to describe. And because you're early on, and because this is all new and it hasn't yet been done before, it's maybe a little bit more of an abstract Picasso than it is a, very clear photograph. And so the description is harder. It's up to you to be able to make the person with the blindfold see clearly what it is you're doing. So what an investor really needs to see, and I'm talking specifically about angels and VCs, is that we need to see that picture that you're painting for us looks like a machine built around a product. It's not just the engine. We need to see how the car moves, what the chassis is, how the wheels turn. This is a kind of a crazy contraption graphic, which is like there are levers and pull. There are a series of moving parts to any business model, and how they function and move is the efficiency and durability of putting money in on one side and having the business model spit out money in multiples of that on the other side. Your business is sort of a widget to us that we're trying to understand as a money-making enterprise. And we are passionate about your product and the business model built around it. But at the end of the day, as investors, we are looking for you to build a self-sustaining machine of a business that other people are going to want to own. And the reason for that is that we're looking for our cash exit as soon as possible. Hence the spring-loaded leaps to sequences of investors to get as soon as possible to as high of an exit that we can achieve with you. If you're not aligned with that, that's where problems start to come in. But I think then the question is, okay, Minda, how do I paint this abstract picture? And I would say that the first thing you want to talk about is the blueprint for building a machine on the left. The second part is all the kind of components of that, which are traditionally talked about as market, team, product, and go-to-market. But those are all interrelated factors. And I think thinking of them more as a mechanical device, where is the single point of failure? What do you build first? Why is this the team to do it? Thinking of it as not just a description of a execution exercise, but as how are you going to build this machine and in what order and why? And I think what you're doing when you tell that story well about your business model is you're describing why you are the one to build it, because you're knowledgeable about the levers you're creating and testing that are going to make this successful. You understand the external factors that are working for and against you strategically. So hearing you tell that story gives me an indication of the team without you having to just say which companies you've worked at previously. So there are ever-changing stages when you're talking to investors, and these are market defined. There is no fixed definition, but generally, Yoko and I hear in the pre-seed category, when people are raising that first, $500 to $1 million, and it is, small VCs like us with, we don't have billions under management. We are, a different size firm and a different kind of firm. And you'll see different kinds of VCs at different stages. By the time you get to Series A, there's a lot more data and operating information on what your company is capable of as a machine. And so I think that as you look back and see how you get there, people are saying we're doing a late seed raise or we're pre-seed. Everyone has all kinds of different words for it. Ignore that and just really understand that the market's defined these roughly 3 early stages that companies go through, and that there are roughly these 3 definitions that help you segment the right investors for where you are at, which is the other way you can make good use of your time, is to not talk to investors that are never going to be able to say yes to you during this round. So this is a little bit of straight off of Wikipedia, a graphic that is maybe well known to you. But what you'll see here is that the startup financing cycle, the red line is sort of your trajectory through investment. And so I think that what I would want you to take away from this slide is the valley of death is right there. And that's where we invest, is when that risk is the highest there. So that's why you see angels, because we invest when you're in the valley of death and there is no logical, rational reason to be able to take this risk. But you're an abstract painting that we are trying to understand and want to exist. Early stage VCs also are in here, Yoko and I in that category. What you see first, though, is that you are your first investor. And that may mean capital. It really means time and career time. And so making sure that this is the path you want to follow is the investment that you're making in yourself and your career, your time, and often your capital or your opportunity cost of earning. And so there's this stair step that we go through, that you encounter different kinds of investors, each one expecting you to be spring-loaded for that stage to vault to the next one, given invest. We think of that as moving from being all risk to having really established created value. And there are different faith capital, that's where we are, to risk capital, which is there's a hypothesis that has some basis, to growth capital, which is just pure fuel to be able to get to some exit endpoint. So there are different reasons that investors will invest in these stages, but the risk to value pathway comes in when we talk later about milestones. So one way to think about risk is areas that need to be miracles that need to be proven or disproven, things that you can't build something to reduce risk. Often you really can only, these are bigger, often outer things. Value created is not building the software, it's having sold the software to someone for money, right? So there's an idea of, risk being, this is a very crowded market for this type of software. There's nothing you can build to answer that. You have to be in market to answer that. These are questions that are answered not by what you do, but by how the external world, joining as a customer, churning as a customer, all those things are the things that tell you how you're doing in moving from risk to value. It's not something you get to do as a project. It's your project and then external validation of the value of your project. So that's where we are so far. Just understanding the landscape of angel and venture capital, generally why we're asking the kinds of questions we are and what we're looking for at different stages. So we've said it a couple of different ways. So I'll just pause here for any questions before we move into the next segment, which is more about milestone. And I'll take a sip of my fizzy water.
We're good to keep going.
I'll try to bring any questions that are in the chat up if people are posting them in the chat.
Wonderful. Great.
Awesome.
Yeah,
Thanks,
there's
John.
going to be time for questions at the end, but sometimes it's helpful to pause as I transition over to this next part, which I will proceed with. Okay, how's my company? What do you mean by these fundraising milestones? How are they different than just me doing regular goal setting, which I did in my corporate job, or I very much have read? There are 1,000 books out there. Why is this topic unique to what we're working on? And I want to say that there are sort of the differences is on the right-hand side of this picture there are company building goals and milestones and that you do in order to build a good company. But then on the left-hand side is the market for capital. And the founder, kind of squeezed in the middle of this zigzag, has to build their company, but also hit benchmarks to continue to access capital once you choose this path of angel and VC type funding, where it's this compression and spring-loaded exercise. So you're constantly making trade-offs between prioritizing things that maybe have longer-term payoffs for the health of your company versus benchmarks for getting more capital. So it's also to say that when investors tell you what you should be doing or what traction matters, what they're really describing is their knowledge of the market for capital. That's not the same as them making smart recommendations about what you should do to build the real company. Those are two separate things, and I think they should always be acknowledged as separate so that you can make good, you can do good filtering on what you're hearing and from whom versus what you know about how to build your business. You will be capital dependent on that market. And the other thing I would say is if you're like, oh, Minda, I'm only going to raise once. We're going to raise $2 million and we'll never need to raise again. I would say, awesome. That is interesting. Great if you can produce an exit just like you would if you had continued to take capital. However, what I would say is it's always a smart idea to be aware of where those benchmarks are on the other side as you build your company so that you can access capital if you want it or need it and the time is right. So you don't want to get too far out of touch with the market for capital at any time, even if you think you'll never need it again. So zigzag, how do you build your company and access the market for capital? And that's where milestones, we believe, really kind of come in. And the thing we want to kind of orient you to here is the idea that when you make your fundraising ask, it's not, I want to hire salespeople, but it's the outcome that those salespeople generate. That's the milestone. So when I say that I want to achieve 3 pilot, or let's say 3 enterprise customers in my ideal customer profile, my ICP, in 18 months, and have each of them be paying me $25,000 a year in SaaS revenue. If that's my definition of changing the value of my company, then I have some great questions for you about how you got to that assumption. But if what you're telling me is, Minda, I'm going to hire 3 salespeople, then I don't know why. I don't know what you're trying to achieve with that. And I can't fund that. That's funding activity. So what I'm really looking for is how are you moving from risk to value? Do you know in what order you need to build your business and what is changing the value of your company? Because that's what we need to do together to get you to the next stage. Right thing to be doing. However, on the right-hand side are kind of the activity things, like building an MVP. Okay, you built an MVP, but that does not create value. It's when you can sign paid data customers that you have established some sort of value. Again, it's the internal project coupled with the external reaction to it, which is pay for it or not pay for it, or pay more for it than you ever thought. And so I want to acknowledge that a lot of the fundraising slides say, we're raising $2 million and we're going to be cash flow positive in 3 years after we build an MVP this year, and then do our 1.0 release in the summer. And then we're going to hire 2 sales. You're telling me your activities, but you're not telling me how it's moving you from risk to value. You're sort of telling me a little bit about the activity work that you'll be doing, but I'm going to need to know the strategy. So please tell me that, because that's what I want to know if it matches my capital.
And Minda, John was raising a point kind of around like the sort of sequencing and prioritization of risks, right? How do you make sure you're addressing the greatest risks first?
Yes.
Yeah, and I know
so
you
my
have
favorite
great
analogy. Do you want me to give my favorite analogy, Yoko? Because I love this one. Okay, so when you think about like risk, this is a great way I think to think about it, and I think I've gotten a few ahas out of founders, so I'll try it here. which is that imagine if I told you that your company was a monkey reciting Shakespeare on top of a flagpole. Okay, great. What's the first thing you do? Well, if you've built a lot of flagpoles before, you might jump straight into building the flagpole and tell me all about building the flagpole. And I would say, I don't care. And I don't find you de-risking anything about the monkey by building the flagpole. What I really want to know is do you have any access to monkeys? And have you ever taught anyone Shakespeare before? And I want to know that you're de-risking the miracle of getting a monkey to speak Shakespeare. Building the flagpole is not going to de-risk or add value to your company. It's only the monkey part that does. So find the monkey first part of your business model and know that that's what you need to bring forward into your work as a way to change the trajectory of risk to value. So it may mean that the first few years you're not building a flagpole, you're spending time at the zoo and really getting acquainted with how monkeys learn language. So both are worthwhile as company goals, right? Activities and outcomes. And they often match. But really, when we think about capital, it's the outcomes that matter. And the outcomes we want to see are ones that move you from risk to value, monkey first style, in my opinion. Okay, so what we really just went through in a very brief way is my company even a fit for this kind of capital at this early stage? And what's an investor looking for at these different stages in terms of, we looked at sort of what benchmarks kind of exist right now in, that's my slide. It's market defined, not Minda defined. And how is company goal setting and activity planning different from fundraising milestones that you need to be able to substantiate and storytell around? Okay, so the next part is using the model that maybe many of you have heard of called SMART milestones, meaning they are specific and measurable, actionable, reasonable, and time bound. In other words, in 45 days, we will spend this much money to generate this many leads, which we believe will turn into 14 new enterprise customers and add this amount of revenue to our annual run rate. So what you see in there is something that is objectively going to be able to be checked off or not. You're going to miss that. And there are a whole bunch of assumptions behind it too. So SMART milestones create clarity, and that's why I encourage people to think in this way, because it leaves you a whole lot less wiggle room. But what it does is it helps you with this exercise. And my crazy gear machine here is what I'm going to explain next. And this is the way I think about it. So you've got your SMART milestone, right? Your strategic milestone, a strategic milestone that's moving you in the right direction, let's say. You take that first and you say, okay, what's my time frame for this thing? Because time is fixed. That's why it's the little dial in the center. You don't get to change time marching on. There's no replenishing it either. But you pick a milestone you think fits that time frame that you're kind of set on. Maybe it's 18 months. And then you want to kind of see, okay, let me test out this milestone, because I made a whole bunch of assumptions in order to write that milestone out. And so it's time to unpack those. The ones that some of them are just internal beliefs and some of them are assumptions. And then you're going to need to sketch out a little bit of sort of the project planning execution side of all of those assumptions in that time frame. So an example here is when you are looking at paid customer acquisition, and this feeds into the example we're going to see, you're choosing that time frame where you have some certainty given the wild ambiguity of what you're doing. And then you're going to write that out. You're going to start capturing assumptions. You can see some examples here, like, I believe that we can close a contract after just one sales call and a product demo, right? That's an assumption that you have to go out and validate. Maybe it's not true. Maybe you actually need like a whole other layer of approval that you don't yet know about because you defined your ICP in an area where you still have some knowledge to gain about what the sales process is or the buying process is on their side. So that's the kind of thing I mean by time frame, a SMART milestone, and a couple of assumptions here, but I would encourage you to go a whole lot deeper and longer than that. You can just generate as many as possible, put them into some categories that'll help you, and then figure out which are the most relevant ones to really sort of test. So the next part of this is going to be what I call comic strip modeling. And that is because most founders are not spreadsheet first people. You count yourself among that or relate to that, but I do. And so a lot of times you'll think, oh, I need to build a whole financial model. And that is embarking on a pretty, it's a real project. But for the purposes of what we're talking, is this milestone going to work as one for the next 18 months? I should figure that out up front if there's any gotchas in there. And this is how I recommend doing it. First, capture your assumptions. On the left-hand side, that's what you're seeing here, right? It's a way of saying, I think, number of leads I can generate, the cost per lead that I believe I can achieve, the conversion to a first meeting. All of these in blue are sort of my input assumptions where I've not only captured the assumption, but I have quantified it. And that allows me to sort of play through a scenario at a very light, so you can see this is like really simple Excel, but powerful because look what it caught. It caught the fact that in bright red, you can see that you would flag that, oh my gosh, what that means is that that looks a whole lot like 75 first meetings. And then you start thinking about, well, who's going to do that? And a lot of times you're thinking, oh, we're going to have to hire someone. Okay, now there's a cash flow implication, right? So playing these things out. And, are these meetings all going to happen 2 per day? No, they're going to happen like 5 one day, 10 another, 2 another, 0 another. And how am I going to balance other activities around that of building my company while I'm working toward this milestone? So making sure that there's bandwidth on the team. And then also, looking at the budget of cash versus when revenue comes in, there's often usually quite a difference there. So really also monitoring the cash flow implications of that spend that you're putting out in order to get the revenue result in return. So these are the kinds of things that I call comic strip modeling, because it is like a comic strip is like 5 panels that tell a whole joke, but they're sketched out in a newspaper every day, right? They're very quick and then gone. And so that's what comic strip modeling is. It's not necessarily intended to be a financial model. It's there to test a scenario for a milestone so that when you go to build your fundraising ask, you're saying, I know why I need money because I've decided on the strategic milestones that matter, and I've dug into them enough that I believe I can execute on them, right? So now when I've done that, I also know what the cost is. So I know how much I need to raise. So I don't want to raise too much and I don't want to raise too little. You can see here sort of the Mad Libs formula for how we sort of say this, which is Mr. or Ms. Investor, we need to achieve milestones A and B. And you can say why you know that to access this kind of seed funding. Because again, aligning with us means you're leaping forward to a new set of investors. And then to get there, we need these kinds of resources, which are people and capital and time. And what this means, this short sentence means you've done a lot of homework that then an investor can unpack with questions that you're prepared to answer and say, yes, I thought about that. And when we did this calculation, I consulted with someone who knows more about paid advertising than I do. And what they told me was that the price of a lead in this kind of area right now is about that. So you're going to have backed up some of your execution areas so that if an investor believes that you should build this machine, they're also seeing that this next phase is well thought out and that their capital is going to be put to immediate and good use to change the value of your company and unlock that spring. Just to recap what I just was talking about, it's really about using that iterative model around a set period of time to pencil in a milestone, check your assumptions. Are they, did you miss something there? Or is there some is there something that you're kind of that's lurking as an assumption and you just kind of have a belief about it? And then comic strip modeling to kind of validate that, yes, this could all work together. In other words, the gears can turn. So that intro to comic strip modeling is really sort of what I'm breezing over here, which is what a lot of people might do when they just pop open a spreadsheet. But if you're not a spreadsheet native person, and that's not the first place you go, I'm showing you that you should open a spreadsheet and you can get sufficient information to be able to validate something without having to go into building a full financial model. That should come as well, but it's not necessary for you to be able to do this part per se. The financial model is really about modeling out the business model and what the assumptions and levers are so that you can see if this car is going to run with those kinds of tires that cost X amount. Is this going to be the right size of engine? Is this, it's all the moving parts components. And then that is the sort of numerical way of playing with your business model. Okay, so with that, we will take some questions.
Feel free to add in questions either in the chat or raise your hand or use the hand raise feature, I guess.
Yoko, I must have done such a good job. They have no questions.
Yeah, this is awesome.
I can go first.
I confused them so much that they are really lost and they're going to have to watch this recording again and try and figure out what they just heard. So
It sounds like
one
Kyle
way or
has
the
a
other,
question.
I would love to hear some questions to know a little bit about what you just heard.
Maybe you should drop your slides and then
Sure.
you'll be able to see people.
Yep.
And I think Kyle
I
had a
see
question.
Kyle has an opinion.
Yes. Hi. Thank you. Thank you for this. Very well put together and got a lot out of it. I'm a new angel here based out of Boulder, Colorado. And what would you say to an entrepreneur founder who, as a matter of fact, this happened yesterday, was kind of complaining about having to constantly try to fundraise, constantly try to grow the company, constantly trying to meet milestones, and seeming like he's not getting anywhere in all of those three categories. So
right. So
well,
they were describing what I framed up as a zigzag, right? And that being on that zigzag is exhausting for founders. That is a squeeze and it's not fun. I would say that back up and I would want to understand what their business model is to understand how well it maps to angel and VC capital, if that's what they're going after. If that's already out of alignment with what their business is fundamentally, that may be one of the reasons. And that's pretty unchangeable unless they change their business model, type of business. I think then the next question is, are they segmenting correctly who they speak with and getting no's from? Are they getting no's from people who are no matter what? Or are they getting no's from people who are potential investors and who are saying no for a variety of different reasons? But usually it comes down to, I don't believe you can do this. Because the ideas are almost always good ideas, but there's something about their belief in the spring loading and the team that's not coming through, or, in some way. It's not that the investor is correct. It's that that's their belief. So how are you walking them in blindfolded? And what are you doing when you are describing that piece that's not getting through to investors?
yeah, and thank you for that. Very helpful. And I think part of it is also that the segmenting portion that you alluded to, he did voice some complaints about going to VCs where on their website they say we do pre-seed, but when he finally gets a meeting with them, they're not interested because he's not at the AIR that they're expecting. Yeah.
And I think that's a dynamic of him encountering the benchmarks for capital that have changed.
Yeah.
And it's different. If they talk to someone who fundraised 3 years ago, it might have been a different response. And also there's a real different, the yes and no about how far along you are has a lot to do also with things you've done in the past. What major miracles have you pulled off in your prior experiences? And I think that gives a lot of subjective kind of input to an investor about how fast you can move and how big of a boulder you can get going up a hill. And so people who have that more established track record and evidence of it are able to sort of look further ahead than they might really be. Sometimes that benefits them, other times it bites them.
One thing I'd
Definitely. Thank
add,
you.
one thing I'd add to that, as Minda alluded to, the market for capital is sort of the key piece. And so, if this founder is running into sort of some mismatch with what's on the site and sort of the meetings they're having, talking to founders who have raised, especially in the region and the sector, I think that's really important to have those conversations regularly, because you start to understand.
And business model, right?
Yeah,
If
totally.
if you're a hardware person and you're talking to someone who raised for a SaaS business model, you two are not the same.
Yep. And it helps you kind of really understand what makes you exceptional. To Minda's earlier point, like maybe you don't have the traction, but your team is like super deep in some sector or whatever it is. Like what's real, rather than sort of the generic summary piece, you have to really understand like what makes you exceptional, memorable. And it sounds like there's maybe a little bit of poking to do for this company.
To put some words a little more in a different context, same thought, just different words to do it. When I hear Minda saying spring loaded, I hear doing your homework. And so when you have business and you ask for money because you have activities you want to do and you haven't built your traction up, then you're not ready for pulling the trigger and making spring go. And so when you ask for the result, but you haven't done the homework, then getting a no is not surprising, right? And
because
so,
again, John, you've said before, investors don't want to pay you to learn.
Right. So
they don't
the
want to pay you to do
investors
your
are
homework.
looking for the opportunity for how that investment makes progress. And the fact that you are creating activity doesn't translate to progress. And if what we're doing is paying for your research on one side or education on another, that's not an effective use of our money to make progress on making the money bigger. And so
again,
there's
I
homework
think the key thing there too is to say for our capital. And that doesn't mean like I want to keep my capital. It just means that my capital has an agenda. My capital's agenda is to be part of a leapfrog opportunity. If you can't show me that, you're not a fit for my capital. But a lot of founders here, I don't want to give you money. And so I always want to distinguish that so founders hear more precisely what's being said.
And to add to that, I've actually had conversations with the portfolio companies where they were really stressing about, we need to add a customer each month. I need to keep going. I want to show you that I'm making progress. And I said, I don't actually care about each new customer every month. That's not showing growth. I would rather see nothing for 2-3 months, and then suddenly you're starting to add 10 at a time. Right. That to me is meaningful, like that kind of meaningful learning. You're starting to understand the components of your machine, and we are starting to understand where we can start to pour some gas.
Right.
And one of the complaints that you'll get, Kyle, is that you get contradictory advice from investors. And often that contradictory advice is actually quite accurate advice in the right context. And that what you're seeing is that the investor has assumed a certain context about where you're at and then expressed how to get out of that context to the next place. And that often translates to stages of what things that you have accomplished in your homework, right? And if you haven't done your customer development, if you haven't done your financial modeling, there's a bunch of places where you chose not to spend your time because the other thing was more interesting, then you may not have completed the thing you need to do for.
And I think the best way to show completion isn't to tell me how many customers you interviewed, but to show me the result of what they did because you put something out there. That's having done your homework. It's the going from 0 to 10 customers that is showing me you did your homework. Something you did there was the right answer, right? And so the activity isn't what you need to bring to an investor, it's the result.
Which for lean startup fanatics like me means that when you're doing your customer discovery work, you're qualifying your customers by making them pay you money. And that's before you've defined the solution. You get them to pay you money to know that they're actually customers. Then you ask them the illuminating questions. And then you discover the one feature that allows you to build whatever the thing is you're going to build when you get to some notion of completeness on the business model.
Right, because what I love about Lean Canvas too, John, is that it really says that customers and revenue are the trailing indicator of something that happened before that is value that they want to pay for. And so often when you're talking about traction, you're talking about both sides of that, the revenue and the path of it. And then also, what are those leading indicators that you discovered when you got someone to pay?
Yep. And it ends up being a filter for the adoption curve. And you want to be on the right side of the adoption curve. But more importantly, you want to do the same kind of thing with your investors, because that's a sales process too, which means that you've had to done the filtering on what's the stage of the investor and where they're spending their time and money by doing research on them.
Good. I hope we hit that question hard enough. Move on to something else. Between John, me, and Yoko, we will always have a lot to say on these kinds of topics. And hopefully one of our ways of saying it resonates with you. But again, what we're trying to tell you is not advice as much as ways to think about something or ways to unlock your own pre-existing knowledge. It's not about telling you which order your pitch deck slides should go in. That would be advice, kind of tactical and prescriptive. So hopefully we leave you with a lot more questions than answers, but hopefully they're closer to the right questions that you should be asking yourself so that you're focused on using your time to your best advantage if you're a founder in the room. And if you're an investor in the room, then you got a chance to see how Yoko and I think when we talk to founders, because really this is how we dial in on, being blindfolded and getting to see something, is that we have to choose our questions really efficiently and really quickly. And so the more we think about it, the more we talk about it, the better we get. So we always learn something from your questions too.
So I'm going to pick on where she has something to say, because she's about to do something important.
I don't know how I managed to get picked on, but
welcome to being a fund manager with John.
Yeah, so nice to meet everyone. I'm Waverly. So I am for conference, or SAC as we call it, coming up soon enough. So we'll be starting in the springtime, so late February. And it's a program where you have the opportunity from the investor side to try it out, experience angel investing sort of end to end. So every time that we do one of these conferences, we try to ensure that 50% of the voices in the room are new and 50% are returning, so that everybody who's participating has an opportunity to learn something they didn't know from both directions. So we're definitely getting teed up to get folks involved on the investor side. We also have, of course, lots of companies that participate. So we go kind of American Idol style, from 80 to 90 in the beginning, all the way down to one winner. But one of the exciting things along the way is there's opportunity for interaction. There's opportunity for founders to get feedback. And as we sort of get to that final round, there's lots of opportunities also to just do diligence and understand really how the financial part of all this comes together. So if any of that sounds interesting to you, I'll be the point person kind of going forward as we do the planning over the next few months, and excited to just keep, for me personally, it's a learning journey. I came in and did my first SAC and was literally like, I barely heard of this angel investing thing, to now I really want to dive deep and just become better at contributing to the space. So happy to help anybody out if you fall into any of those categories.
Yeah, so thank you for that. But I was hoping that you had some investor valuation question about how you know that a milestone changes valuation, because I can do a whole bunch of wiggling on one of these startups, but it doesn't necessarily translate into a valuation calculation in a way that most MBAs think of it.
Well, yeah, I think kind of going back to the activity versus impact question, to me is fundamental. And I mean, it even comes up, I think, if we separate ourselves from startups and just when we think about any professional pursuit. So to me, I think one of the challenges is figuring out in the sense of not so much what's the activity, but what is the actual impact that is going to drive kind of that larger scale change. And I think it's much more important to be able to communicate that, as Minda was saying upfront, versus kind of here are all the things we're going to do, because that's a lot of translation on the investor side.
Cool.
And there's a question in the Slack about, or not in the Slack, in the chat, about recommending, would you update venture actively during a due diligence or wait for their feedback shared with them? And I'm not sure I understand the question or point of view on that question, but there's something about communication during due diligence. And I'd love to understand what the question is, because I think there are a lot of questions around that process. So if you want to pop on to...
Sorry. Yes, so when you are under a due diligence and they ask you for materials and you send them, and at the same time you have progress on other fronts of the company, whether it's new data or bringing in new marketing team or etc. Do you keep sending them information as you move forward, or you wait for them to give you feedback on the previous information you have shared with them? Kind of take it one point at a time.
Mm-hmm. I would think of this as in the following way, because there's no right or wrong answer to that. And it is that you are a salesperson, like an enterprise salesperson, trying to close a deal. And so you're going to operate in a way that gets you closer to closing the deal sooner rather than later. And so if new information is coming out about your product and there's an update and an upgrade, you're going to want to share that information. You also don't want to keep peppering someone so much that they are no longer listening. And you don't want to have such little communication that the deal momentum dries up altogether. So it's really sort of a dialing in of what is relevant to them making a decision on whether or not to invest in you. And, you know, just sort of managing your communication and your style. Remember, at each juncture and interaction point, whether it's when and how you update them, that is more information for them during due diligence about you as a founder. And so it can be a really positive opportunity when you say, you know, sharing an article that says, you know, about your sector and says, you know, here is this article that on supply chain that really resonated with us because our solution really dives into what they're talking about in that second point where there aren't a lot of solutions on the market, right? So you're sending them essentially something that helps them build their case for why they should invest with you. So help them build their investment memo. If it does that, that's great information to feed them. If it doesn't, then maybe it's your reason to give them an update because you haven't heard from them.
Mm-hmm. Thank you. Thank you very much.
All right. I think we're good. I think everybody else is you know, you had a chance to put things in the chat. Maybe you're just thinking about it. Maybe you want to watch something like this again or dig deeper on your own. But we always really appreciate getting to talk with founders and funders together about these kinds of clarifying things that we think we've got some ideas on.
So thank you guys for being here. We do run workshops more than once a week lately. And so as we do the European version of our program and we do the US version overlapping a little bit, we're running things at various times of the day. But we're putting the recordings on the YouTube channel when we can. And so there's opportunities there. And if there's particular topics that you would like to see, please do drop us a note and we'll try to put a speaker in. We're currently planning out the next 6 months of workshops. So we're working on that process and building out the information base as we go forward. Now, Minda and Yoko and I are all in the early pre-seed and early seed stage, and there's definitely things that are different about the world when you get into Series A and Series B. And so we can also help connect you into follow-on groups of people after you get ready for that. Thank you for coming. Glad to see you all.
Thanks, John.
Thank you all.
Thanks a lot.